Are you looking for ways to build wealth? Then you've come to the right place. I'm Julian McClurkin, the chief storyteller with Tribevest. In this 9-part masterclass, I sit down with Jim Pfeifer, the founder of Left Field Investors. We talk about building wealth through passive investing in real estate. Here's chapter 1. So we're getting ready for this masterclass, and we're going to start off with the first chapter. Chapter 1 is passive investing. And Jim, let's just start there. What is passive investing?
Traditionally, passive investing is investing that doesn't require much from the investor. So you're not doing anything. You're just putting your money somewhere and someone else runs the operation for you.
We're here to talk about investing in real estate specifically. So how is that done passively?
In real estate, you basically are sending money to the operator and they are doing all the work, and the investor has no operational duty. So you send them the money and they do the investment. Now there's significant work up front that you have to do to prepare the investment, to vet the operator, make sure you're in the right markets and all that, and we'll talk about that later. But the basics are that passive investing in real estate, you basically wire your money and then you have nothing else to do.
Got it. When I hear you say the word operator, in my mind I have like the conductor of a train. And is that kind of similar to what an operator actually is?
Yeah, and we'll talk about that in later chapters, but the operator, the syndicator, the general partner, GP, all of those are the same terms, synonyms for the person who is operating or taking care of your investment property for you while you sit back and just watch the cash roll in.
All right, well, let's talk about some of these investments now. Can you give me some examples of passive investments within the real estate realm?
Yeah, so the main thing we're focusing on in this masterclass is private placement offerings. And we'll talk a lot about those. Those are the syndications. Private placement offerings, those are the same thing. But there's a lot of other things in real estate that you can do that are passive as well. Private lending to house flippers, mortgage notes, crowdfunding websites, tax liens. All of those are also fairly passive. And then one of the most popular ones is investing in single family rentals. Now that sounds passive, but you end up managing your property manager, and it's less passive than you think when you're jumping in on it.
What is the most passive real estate investment you could have? And then what would be like on the opposite realm, what's the most active real estate investment you could have?
So the most passive are these syndications we're going to talk about. That's where you wire someone money and then they operate it, and every month they send you a check. And after 5 years or so, they send you your capital back, plus hopefully some appreciation.
Mailbox money.
Mailbox money, exactly. You don't have to do anything. The most active would be the opposite of that, where you're maybe a house flipper, so you have to go find the property, buy it, fix it up, or you're buying a property to rent to somebody else, and so you're dealing with, the termites, tenants, and toilets is what people try to avoid, right? But that's kind of what the management process is. So a lot of people have growth from, most people in real estate, they start at the house flipping, or I want to buy a rental property, and they start with the active stuff, and then as they grow and learn, they find passive, and so it's kind of like a migration. And what we try to do at Left Field Investors, and Tribevest helps a lot with this, is maybe skip that active part and just go to passive, right? Do your job, do your W-2 job, whatever you do, and then on the side you can do some passive income investing, which helps you build your wealth.
The real estate market, especially right now, a lot of people are predicting that we might have a correction coming, and because of that, they're sensing some volatility within it. But there's volatility in the stock market as well. Let's talk about a little bit why it would be better. I know you mentioned index funds. Why would it be better to invest in real estate rather than like index funds, which have a constant rise over time?
That's a great question. And index funds they're set it and forget it money, right? But what you're doing when you buy a stock or you buy a mutual fund is you're buying something and betting that someone's going to pay you more for that asset, that paper asset later, right? You're not getting very many dividends. You're not getting very much cash flow. You're hoping someone pays you more for something later. So in real estate, there might be fluctuations in the market price, but I don't care because I'm getting cash flow, and that's what I'm investing for. And the appreciation is just on the back end, and that's a bonus. Another thing with real estate is you can force appreciation. Meaning you can make improvements either if you're active yourself or if you're in a syndication, the syndication operator will make improvements to the property that will increase the value of that property regardless of what the market is doing. If you're in index funds, you're coasting with the market.
Yeah.
If you're in real estate, you can create your own your own value in that asset, and you're always receiving income as you go.
That makes sense. That makes sense because people would look at, investing in stocks and in index funds and saying, an index fund is like, can you explain what an index fund is, where it's spread over multiple companies?
An index fund is where you pick an index. It could be the S&P 500, which is the 500 largest companies in the US, or it could be foreign stocks. And you basically invest in every one of those stocks through a fund so that you're basically getting the returns of the market. But now it's looking like perhaps if everyone's investing in index funds, then you lose some of that advantage. And the reason people are so much into index funds now is because you don't have to pay someone to actively manage the fund, right? So the expenses are much lower, so your returns are much higher. So it's similar in that they're both passive, what we do, the syndications, and index funds, but that's really where it stops. And you'll see as we talk about all the advantages of real estate, that it's really a better way to go than the index funds, in my opinion.
Right. I know, I agree, because there's so many different ways that, your investment, you can force appreciation on your investment. You can't force appreciation on an index fund. It is what it is.
Right.
The price is what it is, and it's going where it's going. So the index fund reduces risk because it kind of spreads your investment around, but with real estate, aren't you a little bit overexposed because all your investment goes into this one thing?
Yeah, that's a good point. So if I had $25,000 to invest in an index fund, it would be spread out over 100, 500 companies, right? But if I'm investing in real estate, syndication, usually the minimums are $25,000, so I'm in just one deal. But there are a lot of ways to spread the risk. You can invest in multiple deals with multiple sponsors, so you're with different operators. You're in different markets, so maybe you have one property in Phoenix and one in Dallas. Different asset classes, so maybe you do multifamily apartments and then you also do self-storage. And then you can use a company or a platform like Tribevest to reduce the minimums, right? The minimum's $25,000, but if you go in with 4 of your friends, now you can get into these deals for $5,000. And so if you have $25,000 to invest through Tribevest, now you're in 5 different deals, maybe you're in 3 different markets, 2 different asset classes, and that's how you get diversification and you decrease the risk of the investment.
That's awesome. It's like you created your own stock market.
It's exactly right, and that's what you try to do, is you try to balance it out with different investments, different places, and you're creating your own real estate syndication index.
That's
almost.
awesome. Yeah, that's cool. That's cool. Investing in real estate seems like it's more difficult than just putting your money into these index funds. Just in summary of this chapter, what would you say to somebody who's looking to invest some money and they're trying to make the decision between real estate and the stock market?
Well, as with a lot of things, it is complicated until you know and understand it and learn it a little bit. And the purpose of this webinar and the purpose of Left Field Investors is to educate people on alternative investments. I don't like that word because alternative means basically just not Wall Street stuff, right? But it's not alternative, it's the house you live, it's where you store your stuff at the self-storage facility. I mean, they're real assets. But there's a bunch of benefits to real estate investing that you don't get from the stock market. And you'll learn about those throughout this webinar, but some of them there's significant tax advantages. You can use leverage to increase your returns. It's comparatively stable markets. Your asset values aren't going up and down as much. You have protection from inflation and consistent cash flow. And then the appreciation, that's just the bonus. All the other stuff is the best part. And then appreciation is like, you don't need it, but you love it when you get it.
Well, stay tuned for the next episode. We mentioned a lot about syndication. We're going to be harping on that a little bit on the next one.